This will be the review for the midterm. So the midterm, as I said, is going to have 40 questions on it. They're all going to be multiple choice. It's going to be on Blackboard. There shouldn't be any sort of drama associated with it. You'll have the entire week to do it. And I guarantee you, somebody on the last day is going to have some sort of issue or something. But whatever. Try not to put it off until the last minute. Give yourself a few hour buffer. But I'll close it out on Saturday night. Um, not this week, but the following week, just as per the syllabus. And then you'll be off to spring break. We won't have a regular lecture next week. You'll just have to do this exam. So it shouldn't be too terribly bad. Um, it's not open book. It will close once you open it. It will close 60 minutes later. So, um, and nothing else. So e-learning is not involved. RP Now is not part of this. There's no scheduling required. You just open it and take it. So I don't think there's any more to be said on that. In terms of the review, I'm going to go through, and I've got the test near me, and so I'm going to go through the subject areas to make sure that you understand the stuff. The nature of the test, well, number one, it's I don't want any surprises, but number two is I want to make sure that you get the essential elements, of what's important in personal finance. Again, sounds kind of arrogant, but the things that I think are pretty key that we've talked about because I don't mind getting off into other areas. Unfortunately, in a distance class, there's not any student feedback, so we tend to not delve off in other areas unless I bring it up. But anyway, and feel free. You can always send me email questions if you have specific questions about stuff to, kind of further explore, especially right now. Man, there's some interesting stuff going on up in Canada with some of the financial services that are kind of scary. But as you know, I'm kind of a crypto guy, and I think it really is more of an enabler for crypto than anything else. But anyway, right off on a tangent. Opportunity costs. So when we're talking personal finance, or anything in life, if you're doing one thing, you're not doing another. If you're obsessively watching TV 24/7, you're not doing much else. You're not going to the gym. You probably do find time to eat and that thing. So anyway, there's all sorts of things that can happen to you if you don't kind of get your priorities straight. And opportunity cost in personal finance is a key issue. So what that means is if you're doing one thing, you're not doing another. You're foregoing something. So if you're all wrapped up in payments and spending a fortune on just keeping up with interest payments on credit items you bought, you're probably not investing. If saddled yourself with an unreasonable amount of student debt, I mean, obviously, investing in yourself is a good thing, but living a lavish lifestyle because you can get student loans to do it is well, it's probably not happening, number one, so I'm not going to be overly dramatic, but anyway, if you did happen to do that, it would there would be some consequences because the opportunity cost when you're trying to pay off those loans, um, in the point in your career when you should be investing, would obviously suffer. Okay, another one on opportunity costs. So yeah, something like buying a new car rather than paying off your student loans. So the big issue is, for you all, for kind of the tried and true thing of financial success. Again, tends to be with real estate, not only for quality of life, having some place decent to live, but also building wealth. Stock markets, other investments go up and down, but real estate tends to be a safe haven that has a tax preferred status, and always kind of will. Not only do they have a strong lobby, but it's also, good for society and everybody else for to have people with stable real estate holdings. So that's a good thing. And so anyway, my point with this question is that as opposed to buying a new car, um, rather than paying off your student loan. Nowhere in this equation is you saving money to purchase a house. So that's the big picture. You need to uh, start focusing as quickly as possible on investing, once you get out of school and get a normal income coming in. When do you start retirement planning? Immediately, as soon as possible. So you can go back to those charts, just for mechanical aspects, that time value of money. If you're under the illusion that, well, I can't put away much money when I'm young, it makes much more sense. I can put away 10 times the money when I'm in my 50s that I can, in my late 20s. Well, guess what? You will need to put away that kind of money later in life to even come close to matching the amount of money it would have taken when you're younger. When you're younger, small amounts of money can grow into vast sums, but when you're later in life, due to the time value of money, you don't have enough time for time value of money to act upon that money, compound interest to compound. And so anyway, you need to start as early as possible. And obviously, you can look and look and look in every story, any advice out there, it talks about people basically waiting too long. If your spending exceeds the amount of income. So again, this is just sort of the nature of the test. There's not a whole lot of lists or anything else, not a lot of math, just kind of general questions. And so how do you do that? If you're spending more than you're taking in, well, you could, maybe sell some stuff. You could take some loans. You could work harder. You could do all these other things. But those are all just short-term fixes for a basic problem. You need to reduce your spending. You need to get your spending to a level that matches your income. Otherwise, there's no fix there. When we talk about liquid assets versus illiquid. Liquid has to do with cash, the ability to turn that asset into cash. So, coming right back to real estate is a fantastic investment, but it is not liquid. There are so many ways to torpedo a deal, just the mechanics of a real estate transaction, especially a conventional one where there's loan approvals and waiting periods. I mean, 6 months turns into whatever, 6 weeks is on the short side. Now, sometimes you can sell stuff for cash, but that's pretty rare just due to the sums of money and the title searches and all the whole bureaucracy of real estate transactions is set up for at least a minimum of a 6 week turnaround. So if you're trying to whatever, 6 weeks is not liquid. Stocks are liquid. You can get that money out quite quickly. There's some false whatever the stocks people sort of like check float. They play the system where it takes 3 days of settling time before you can get access to the cash typically. That's just a scam. That's just the brokerage services wanting to use your money for a little extra time. So I would think in the next few years, or at least within 10, all those artificial waiting periods are going to probably go away. And anyway, just like crypto or something else, it should be instantaneous because everything is done digitally. So they're fooling you. Now, liquidity doesn't speak to the wisdom of selling. Just because I say you can sell stocks instantaneously and get the money within a matter of days doesn't mean that it's a good time to sell them, because an asset like equity in a company, a stock, the price is going to fluctuate. So um, cash is has a stable value and is completely liquid. And so if you're looking at something where you'd want liquidity is number one to cover um, bills that are coming due, but also emergencies. So if you're putting together an emergency fund, you're looking for something with some liquidity to take care of that. All right. Um, Yeah, one of the distractor questions they have on this liquidity asset is stock held in a retirement account. Now, the stock held in a retirement account is liquid, but again, in a retirement account, it's still going to have a couple, 3 days. Plus, say in a retirement account like a 401k or a IRA, an individual retirement account, when you pull that money out, if you are not 59 and a half, at least that age, you're going to lose 10% right off the top for a penalty. And then all that money is going to flow into your regular income and be taxed. So they try to make that painful, and that's why that's not a good option. Um, we talk about short-term and long-term liabilities, and just if you hear the term here, short-term or long-term, just think of 1 year. Less than a year is short-term. Long-term is more than a year. And so if somebody inquires about your long-term liabilities, those are loans that are have a period of greater than a year. And the most prevalent thing, and the reason we use the 1 year, is to be consistent with the IRS, because if you make money on certain investments, um, the capital gains is going to be figured depending on whether it's a short-term or a long-term asset. And if it's a short-term asset, it's going to get thrown into your regular income and perhaps be taxed, maybe around 30% or higher. I mean, if you're living in California, with your combined state and local, it's going to be about 63% tax if you're in the super high brackets, and good on you for, making that kind of money. But anyway, it's going to be quite painful. Whereas if you kept it a year, it would be charged as a long-term asset, which would be down about 15%. So a lot of moving parts. Depends how much money you're making and other things. But some of these guys who are day traders, it's a great thing, but it's you know makes it difficult come tax time, since they don't hold the majority of their assets for anywhere near a year. Um, when you're measuring a person's wealth, what's the best measure? So again, net worth. Net worth is where you get your assets and you subtract your liabilities. So, you know, we've seen people with a lot of stuff, but if it's all under a loan, it's if you've got a huge house but you don't own any part of it, you just have a huge mortgage. Now, that's not necessarily a bad thing. That may lead to great net worth in the future, because let's say I've got $1 million home and I'm controlling it with $100,000 worth of equity, $100,000 worth of my money, and it's you know controlling this $1 million asset. And let's say that $1 million asset's going up 5% a year. That asset gain represents $50,000 a year. So with $100,000 a year, I'm controlling $1 million, which is generating 50,000 in basically, well, it'd be interest if I could realize it, but if I sell the home. So anyway, that's a fairly astounding rate. That's 50% of interest if it's done conventionally, and that's based upon margin. So anyway, we're off into a tangent there, but for main things for net worth, truly what somebody's worth is their assets minus their liability. So, in this case, that $1 million home that you're living in only represents $100,000 worth of net worth. Net worth in that equation, we'd still have to look at what your other liabilities are. So, in this case, the net worth would actually be quite negative, because you'd have 900,000 of liability and 100,000 of equity. So you'd be a fairly high negative net worth. Monitor debt level. Again, living within your means so that you can cover your monthly payments. So there's, ratios, liquidity ratios, or total debt doesn't exceed your annual income. No, that's artificial. I mean, buy a home and you'll have more debt than you have income in 99% of the cases. But anyway, managing your debt, monitoring the debt level so that you can cover the monthly payments is the important bit. Money being received today is worth money in the future. So you see this over and over again, with lottery type things or something like that, where you can have whatever, maybe $1 million today, but if you want to take it over, the series of 20 years or something, we'll give you 5 million or something. That's not because they're generous. It's because that's the time value of money. The fact that they don't have to give you the $1 million up front means that they will be earning interest on it in that period, and they can pay it to you in the future. And given inflation as well, that money will be worthless. It's hard to say. It's not worth less. Well, it's worth less, but it's not worthless. Anyway, you know what I mean, because it won't have the buying power that money today will, nor will it have the opportunity for interest to be earned upon it. So, another time value of money question here implies $1 today is worth yeah, if somebody wants to give you $100 right now or $100 a year from now, take the $100 now. And we've talked about compound interest. And compound interest, the reason it works is because you're earning interest on interest, not just principal. Principal, if I give you $100 and you put that in the bank and you start earning interest on it, that $100, that's defined as the principal. After a certain period of time, you have $101 because you earned some interest on it. So now you're earning interest on $101, and awfully, it seems like small amounts, but it adds up. Again, it's kind of like office space where the small little increments over time and repeated frequently, compound interest, compound daily, it really starts to add up. When you're doing your taxes, you have certain choices to be made. Some are elective. There are some things strategy wise that you can do with your taxes. But one of the first things to do is in your filing status. Now, if you're single and you don't have any dependents at all, you're stuck with that. And that's going to be the most expensive option. You can also, if you have children or somebody you can claim as a dependent, and I believe this includes, perhaps an elder living with you that doesn't have, much income and is completely dependent upon you. Anyway, you have to do your research on that. But if you can claim somebody as a dependent, then you can claim head of household, which would lessen the amount required in terms of taxes. And then if you're married, now it's typically the current tax code where just about in all cases you're better off filing jointly. But if you have some weird income disparity thing or perhaps whatever, just some different situation, you always have the option of although you're married, you can file as single. You don't file in the single category, but you file married filing individually. So again, that's where software and or tax advice becomes relevant, because you can run it both ways, run your taxes both ways, and see which one's the most fortuitous. Um, yeah, and in certain cases, yeah, if you're claiming head of household, you by definition would be single, because that's part of the going in argument. The reason only, if you're married, you can't claim head of household, right? Because you have your own category. You have to be single to be filing in that one. Here's a lady. She sold some stock, made some money on it. Um, and so what do you need to know? You need to know, did she pay a commission? There's nothing listed, so you can assume nothing. And so, if she sells it for one price, or buys it for one price, sells it for the other, then that difference is her capital gain, right? Or you can just say gain, whatever. And what period was it? Less than a year or greater than a year? In this example, it's greater than a year, so it's a long-term one. Um, if you purchase items on credit, will it help reduce your taxes? Obviously, it depends on the item. So it used to be a time, and we're talking a long time ago now, probably in the 70s or something, where they used to allow you to uh, deduct your interest you paid on other types of credit, like credit cards and other things like that. All those things are gone, but the one that exists is real estate. So each year, if you own a piece of property, if it depends on whether it's income property or your own, but anyway, you get a 1098, just an IRS form, and it shows the interest paid. You enter that in on the taxes, and boom, that interest is tax deductible. Um, how do banks work? Basically, they loan money out at a higher rate than what they pay you. So, if a bank pays you whatever, couple percent, well, they usually don't even pay a couple percent interest. But if they just pay 1% interest, that's because they're, you know, loaning that money out, renting that money to other people for say 4 or 5%, and so they're making a little bit of money on the difference between those two, and then also a little bit of a holdback to cover any losses that might happen or any risk they're exposed to. So that's why if it's a collateralized loan, a loan that's secured by, a house or a car or some sort of item noted in the loan, the interest rate's going to be lower because they've got some protection. If it's just a credit card loan, it's all on them. That's what you would call a signature loan. It's only guaranteed by that person's promise to pay. They could go after you in court, but it's going to be involved, and they'll spend more on legal fees than they will on getting their money back. So it represents quite a bit of risk to them, and so the interest rates are quite a bit higher. Um, quick access to funds. Yep. Again, we've talked about liquidity on that. Can you use credit as a source of liquidity? Yeah, as long as you can pay it back. So the potential for finance charges of what exists out there. But if if you want to have an emergency fund, um, by perhaps having an emergency fund in some brokerage account or something like that, and having your credit card with either zero balance or a large balance available where you could charge something on that, that's a good source of liquidity. If you stop payment on a check, yeah, the only way that works, and it becomes less and less relevant as they process checks digitally. But in the old school method, you could stop payment on a check until that person has taken it to the bank and it's been cleared. So anyway, once it gets into the bank, or even you see now most of the for retailers who do take checks, they normally process them electronically, which means that there's really no float. There's no time period that goes from when the check is presented to when it's um, obligated against the funds in that account, or the funds are obligated. Overdraft protection, yes. So anytime you have a checking account, you really should have overdraft protection. Things will happen. I've had, I consider myself fairly responsible, and I've been in overdraft situations. Number one, because I'm not going to keep an extra, balance in my checking account. I want my checking account fairly low because I'm not earning any interest on it. And two, it presents a huge target for identity theft and other things. So there'll be situations where, I'll deposit a check and the amount will be unintelligible or whatever. The bank can't figure it out, and they'll just return the check to me. And well, here I've credited my account with this check already, and then the check ends up coming back to me, and I need to take it to the person to get them to rewrite the check or whatever. There's a number of things that can happen, and you can just make an error on your own. So we'd all like to pretend that we're not going to ever overdraft, but it's going to happen. And if you don't have some sort of overdraft protection, what normally involves you having a credit card or something with that company with that bank, where they just roll that um, overdraft on the account, it's going to get quite expensive for you, and you can't argue with it. Essentially they're saying, you broke the law. You wrote a hot check. You didn't have funds in that account or whatever you overdrafted, and they're going to hit you, say $35 or whatever on both the merchant will hit you, the bank will hit you, and it's just a stream of charges that were unavoidable if you had overdraft protection. Valid reasons to borrow funds. Um, yep, except for if you're borrowing money for everyday living expenses, that's not a good thing. But for medical situations, especially as we talked about healthcare last week, most of the bankruptcies, it's when you hear somebody went bankrupt, more the vast percentage of those folks is not because they're financially irresponsible. It's because they were faced with a tough decision, and yeah, if you're sick or you have a sick child or somebody, and the choices are going in debt or resolving that situation, you're gonna do the responsible thing, which is probably being irresponsible financially, but that's the situation you're stuck in. So anyway, what you don't want to do though is be borrowing money for covering regular expenses. That's unsustainable. When using your credit card, pay off that balance every month, right? If you do that, then you're a convenience user. You're not paying the exorbitant interest rates. You're getting all the benefits, and that's how you should do it. If you take a cash advance, if you happen to use a credit card like an ATM, um, it's not going to show up as just a regular charge on your credit account. There's a convenience fee that's associated with those typically, and then that period of paying off your balance within the statement date, that doesn't apply. They start charging interest from day one on cash advances, so it's quite a bit more expensive. And again, using a credit card, for emergency uses, that's a you know good method, excellent source of emergency funds, especially since that's these emergencies that come up. They're typically can be handled with a credit card, whether it be a mechanic or you know broken appliance or whatever it is. Most everybody in those situations takes a credit card, and then that gives you roughly 30 days to get that money from your other sources to pay off that credit card bill and from whatever emergency fund you had set aside. Yep, finance charges. If you don't happen to pay off that balance, the finance charges will apply to the unpaid balance. When you hear the term APR, what's that mean? Annual percentage rate. So if anytime anybody quotes an interest rate, any financial institution, it's meaningless unless it says APR behind it because you don't know what they're talking about. You don't know what length of term when they say, "Oh, we can loan you the money at 5% or something like that." It needs to say APR or it's you don't have enough information to make the decision because it's not standardized. Annual percentage rate is the way that standardizes interest rates so that you can make comparisons. Reviewing your credit card statement, you have to anymore. It's pretty much imperative. You have to do it online. If you wait for the paper statements, number one, most people have gone paperless anyway. But you need to check for fraudulent charges. You need to make sure that there's no duplicate charges, and then also while you're there, you can look and see how your spending is going because anymore they do all the categorizations and stuff. When I'm doing my taxes like this time of year, I literally will print out, not print them out, but I'll put them on an Excel spreadsheet, and I can capture my business expenses because with very few exceptions, everything I do is related to business. So that's why having kind of multiple small businesses is helpful because it helps you. I don't know if I'd want to say finance your hobbies, but it does help to do things for work that you enjoy doing in your personal time. So anyway, collateral. We've talked about collateral. Collateral is that security. So if a loan is made, collateral is what provides basically that comfort to the lender that there's less risk involved in that loan since there's something to back up that loan. So, if you've got a home loan, the collateral is the home. If you've got a vehicle loan, the vehicle is it. If you've got a credit card loan, there's no real collateral there. So that's why the interest rates are going to be higher. Which kind of loan has the lowest interest rate? The one that's secured with collateral, right? The one that presents the least risk, the one that has, you may think repossessing cars is difficult, but the laws are pretty straightforward and the people involved in that business are pretty efficient at it. And so, yeah, that's a good thing for you, assuming you're somebody who pays your bills on time. The fact that people who don't pay their bills can have their car repossessed pretty quickly and efficiently is a good thing. Cosigners, just don't do it. Look for any alternative. I mean, if you've got somebody willing to, you as being if you're the person without the credit who needs to get a cosigner, there's really no downside for you other than ruining your friendship with the person if you flake out on the account. But if somebody's asking you to cosign the loan, unless there's some sort of blood relative, even though it's still, I just, whatever, I'm not going to be sold on co-signing loans. You should, because they can seize the asset of the co-signer, and it's going to hit you, it's going to blindside you more likely. A co-signer is needed when you don't have the credit, and so they want somebody else to sign on that loan. And now if it's, your child or whatever, and you're trying to help them build credit, and you initiate this, and use some judgment. But if it's just a friend, be very careful. Purchasing a home, yep, the seller pays the commission, so you absolutely do not care to a certain extent. Now you can make the argument that, well, that person selling the home is going to boost their price a little bit to cover the commission. Guess what? They're going to boost that price anyway. Now, if it's a home that's being sold again within your family or something like that, a friend, and you know exactly what you want and everything else, you can do that quite quickly. And you could, even if you're concerned with it, you can get a lawyer to kind of review the documents. You could do most of the stuff yourself. I've transferred property myself, the property I own from putting it from a corporation that I own to in my personal name or vice versa. And I went to my lawyer to have him do it. He's like, basically called me lazy, said just do it. So, went online, found a quick claim deed, found an example, uh, put all my information in there, took it to the title company that actually does that, and all they do is they just put it in with their stack and make sure it gets recorded and charge you $35 for the trouble versus 250 or something if the lawyer had to do it. So not a big deal, but if you're not comfortable with it, you could you know find the property transfer paperwork, find a sample online, get it filled out properly, then take it to a lawyer. And now he's just reviewing, which you should be able to knock out in an hour or two. And so now you're looking at 250, $500 to transfer a property versus 6% of the purchase price if a salesperson's involved. And believe me, don't I sold real estate for a little while, and those guys are not. It seems like, oh man, they're making a ton of money on that stuff. Those guys start out, the first day of every month they're in debt by, I don't know, probably 5 grand because they've got their office bills, they've got their marketing, they've got their MLS dues, multiple listing service that they have to be a member of. Typically, they have all these other fees that they have to pay, and then they have to sell something, or else they're losing money. And you think, well, man, they get to sell these $1 million homes. Those homes turn very slowly. The majority of their homes that are sold are in the more modest range, and they have to sell a lot of them to make money. And then there's only a few of the agents really out there making money. The other ones are just kind of in the game. So anyway, but we'll see. Again, that's going to be something that's going to transition. The 6% real estate commission is probably it's not in stone anyway. It can't legally they can't legally insist upon the 6%, but they can get you to agree upon it, and then you're paying the 6%. But as the digital world, the Redfins, the Zillows, all those people get better. Right now, they're not there yet, but when that improves over a course of years, you'll see that probably change as well. All right, disadvantage of the homeowners associations. I could list numerous ones. So you'll find two groups of people out there: people who like homeowners associations and people who hate them. Obviously, I'm in the latter category, but there are good things they could do, and there's bad things they could do. And one disadvantage might be, restricting on how you can decorate the outside of your home. They can, or what you can store. You know, you can't have trailers in your yard. Which, as a neighbor, you might find that offensive, and you're like, "That's great. I don't want people having trailers in their yard." So that's why some people might like the homeowners association. If you're fortunate enough to have a bigger chunk of property, then the goings-ons of your neighbors should not influence you as much. But anyway, homeowners associations are that's one thing when you're looking at a home. Find out what the reputation is. Find out. It's just one of those intangibles that you need to know about before you move into the area, because sometimes those fees can be pretty high. Some developments where the developer wanted to get in quickly and get the property going quickly. Sometimes they'll build their own roads, which means they pass on that ownership to the homeowners association. And now, resurfacing roads can be quite expensive. Now, they since the city's not responsible for doing it, perhaps your property taxes are a bit lower. But anyway, there's a lot of differences in homeowners associations, and before you buy a home in a neighborhood that has one, you need to do a little bit of research to find out what you're getting involved in. If you have a fixed mortgage, fixed rate mortgage, is that payment going to change? No, it will be exactly the same. So if you're doing one of these calculations where you're trying to decide whether to buy or rent, and you say, well, really, it's a little cheaper to rent, which in a lot of cases it is. but there's other aspects to it. Perhaps you need to look at also the tax benefits of buying versus renting. But again, you may still find out that it's considerably cheaper to rent. And there are some reasons in terms of mobility. If you don't have any aspiration to keep it as a rental in the future. But the one thing that is a strong argument for buying a home is that, let's say your mortgage payment is $1,800. That mortgage payment will be $1,800 on the first day and on the 360th month of a 30-year mortgage. It'll be that same amount. So now most people, when they look at their um, mortgage payment, because they have escrow accounts within it, they have property tax and insurance also taken out of that account for simplicity, and also because that's how the lenders want it. A lot of times they want those things in there so that they know that those things are paid, so they know that their home that they essentially own is not going to get foreclosed upon for lack of tax payment, as they want to make sure that those things are withheld. So anyway, those amounts will change, and obviously they won't go down over time, but the principal and interest portion of that mortgage payment will absolutely stay the same. So ARM, adjustable rate mortgage. You'll see those probably pop back into the market here as interest rates go up, because there's some people right now who are, as mortgage rates climb up, they're going to be priced out of the market. And the only way they can purchase a home is to get an ARM, and because it'll have a lower short-term interest rate. And, hopefully interest rates will stay low, or, go back to another rate, and then maybe you can convert it to a fixed. You can refinance it. Or maybe you don't plan on keeping it that long, and you're just going to do the ARM for the time you have the mortgage. But anyway, they really went out of fashion after the big credit, crunch following the housing crisis, 2007 or so. But all things come back after time. Um, on insurance type questions, when we're talking about risk management, avoiding risk is an option. Probably not something you could do. I mean, how can you avoid, you know, all life other than staying inside? Accepting risk, you can do that. You can, you know, try to mitigate what you can, but accept the risk, or essentially sell it off, insure it to another company. And then the last thing is to ignore risk. Now, ignoring risk is not a valid, not a suggested risk management strategy. To pretend that it's not going to happen, not a good idea. Comprehensive portion of an auto policy or a home policy, that's for everything else. In this case, maybe wind, hail, other stuff. They also have in here a neighbor's tree, um, caused by damage to a neighbor's tree caused by your car or other. No, that's not valid. Interesting fact. Let's say you have a home, and you have a big tree on it, and that your tree falls over and crushes your neighbor's car. Is that your problem? It's probably not going to do a lot for the relationship with the neighbor, but no, that's an act of God. So you're not liable for that situation. Now, if you did other things, they may argue in court, oh, you disturbed the roots, you did this, you made the situation more dangerous. But in most cases, a tree falling, whether it, and I've had situations like this because I have a lot of trees, and they have fallen on, crushed some people's property, and you don't want to run out there and point out to that person that, yeah, sorry, you're getting nothing. But guess what? You'll figure it out, because, yeah, it's an act of God. Um, Deductible is the amount you'll pay. Well, in this case, not paid by the insurance company. So if you have a $500 deductible and you have, $1,000 worth of damage, you're going to spend 500. The insurance company will spend 500. Oh, sorry. This slide is rolling on me. I wasn't paying attention. Okay, back to here. Um, what's covered, not covered on a homeowner's policy? Remember, flood, any kind of flood damage is not covered. If you do have flood insurance, you're going to have to get that separately. And in fact, again, the mortgage company will insist upon the flood damage because they want to make sure that their stuff is insured, and it's going to have to be through a federal program. So there's certain things to mitigate, even though you say you have a property, because I've owned in flood zones down in Florida and initially my property up here. And there's ways to, work around it or make it more manageable. And in Florida, they tend to build everything on pilings or whatever that are in flood zones so that the living areas are not subject to to flooding and damage. So you'll still need to have the flood insurance, but the amount of property at risk is, it'd have to be like a 10-foot flood before real things are going to get damaged. But what always happens is, they have these unoccupied spaces underneath the homes and people board that up and they fill it up with all kinds of stuff and that gets ruined and then they find out that yeah, none of that's insured because you weren't supposed to have done that. Um we talked about riders on property. We talked about, well, whether we call it a rider, an addendum, a floater. If you have a bunch of personal property in one category, you're going to need to delineate that. You're going to need to announce it to the insurance company and make sure it's insured. We're up to about 39 questions, so we're getting there. Um, Trying to roll this thing. What's a good way to reduce your homeowner's premium? And same thing with an auto premium is increase the deductible. If you can handle it, if you go with $1,000 deductible, you're presenting less risk to the insurance company. Plus, you're pretty much identifying that you're going to be not much of a nuisance kind of filer. If you've got $100 deductible, they know you're going to be in there quite often to nickel and dime them for little items, and it's probably not going to work out for you. But also, you're going to eat up all kinds of administrative charges with that insurance uh, company. If you have $1,000 deductible, you're probably not going to be talking to these people very often. And when you do, it's going to be for something that's, quite serious. Health insurance. Remember what we said about health insurance? Where do most people get their health insurance? They get it from their employer. So again, it's a pretty good system. One of the few things that's a good system in regards to health insurance is the fact that most people get it through their employers, that they're not reliant upon you know, a government program that perhaps has pretty high deductibles. Insurance is to prevent catastrophes, not be a catastrophe, just in trying to pay the premiums and the deductibles. So that's about it. Um, I'll post this if you have any questions. I'll also post, when the exam's going to be available. Try to get it done, you know, whatever. You don't have to get it done that early, but try not to wait till the last minute because inevitably something's going to fail or crash or whatever, and it's going to cause you problems. Good luck.